Hi, I'm Corey Litzenberger from CGLTax.ca, and this is Brainstorming Plus Tax. In this episode of Brainstorming Plus Tax, we are going to do some brainstorming on income tax on passive investments. Now, as the saying goes that the rich get richer, and yes, we all know that this is true, this will be a fact of life as long as we live. However, while we don't have control over the rich decide to pay their taxes or call home, we do have control over rates we can use to attract them. I'd like to talk to you about an old tax plan in Canada called the Alberta Shuffle. Now, this tax plan was a way of shifting income from a high tax jurisdiction like Ontario and paying income tax in Alberta at lower rates instead. For years, this plan flew under the radar of the Canada Revenue Agency because the federal government was getting the same income tax amount whether it was from Ontario or Alberta, so they really didn't care. It was only after an agreement with the provinces to audit provincial income allocation that this plan's use was drastically reduced. Now, I won't get into the fine details of this old plan, but let's look at the results. Again, the result of this plan did not affect the federal government's pocketbook. They got the same rates regardless of which province it was taxed in. The real benefactor was the province of Alberta. They now had provincial income tax revenue from a source outside of the province to use however they saw fit. Obviously, this was detrimental to residents of Ontario, but if you lived in Alberta, why would you worry about that? What if we looked at this type of plan on a current global scale? Since 2015, we have seen federal income taxes in Canada rise on the middle and wealthy classes. Alberta alone saw the high rate of tax go from 39% to 48% in only a few months. The general corporate tax rate was raised from 10 to 12%, and investment tax rates were raised to 50.67% from the previous 46.67%. We now have new rules on the taxation of investments inside Canadian corporations going into effect in 2019, and we have seen investment capital leaving Canada at an alarming rate. Meanwhile, by contrast, our neighbors in the United States are seeing taxes go down dramatically. Just like the Alberta Shuffle caused the wealthy to take advantage interprovincially, there is nothing preventing the wealthy from doing a shuffle of wealth to take advantage internationally. The middle class are not as mobile. While many middle class may move for work or school, we don't usually move just because of tax. The wealthy, however, have the means to live and structure their affairs anywhere in the world. So what's keeping them here? I'm sure it isn't the warm breeze at Portage and Main and Winnipeg on December 22nd. My brainstorm is this. Just like the Alberta Shuffle, we need to offer a Canadian Shuffle. We need to provide a place of incentive that the wealthy want to call home, a low-tax, safe investment jurisdiction to provide incentive for income to be allocated to Canada, and by definition, income tax to be paid in Canada, regardless of the original source. This influx of income tax from wealthy individuals, athletes, multinational corporations would fill the government pockets to provide services for the residents of Canada. Sure, the 1% would still get richer, but the 1% currently pay for more services than they use. They subsidize our services. If healthcare costs $100 and $40 is paid by the 1%, who picks up that $40 if they leave? In fact, I would not care if the richest people in the world decided to turn Canada into their own tax haven. One rich person does not need a hospital to themselves, but the hospital definitely needs the rich person. What are your thoughts on this? Tell us in the comment section of the podcast, Twitter, LinkedIn, or Facebook, or YouTube, wherever you've seen this podcast. And with that, for CGL Strategic Business and Tax Advisors, I'm Corey Litzenberger. Thanks for listening.